Hello, everyone. Thank you for joining us. With me today, I have Subash Chandra. He's the Managing Director, Senior Analyst for Northland Capital Markets. We also have Duane Dickson, Deloitte's U.S. Oil and Gas and Chemicals Leader. Also, Jim Wicklund, Managing Director, Energy Investment Banking at Stephens. Thank you all for joining us. Here we are. Some may say finally finding ourselves in the new year. 2021 is here. Today, we're going to really have a discussion centered around what you all saw in your respective research and analysis. I really want to tap into your knowledge about what we learned from the North American markets in 2020. I know we can't predict the future, but there's a lot of setup and a lot of knowledge coming from you all about what we can possibly expect from this year, 2021. My first question really, what surprised you about the markets in 2020? I know there were surprises on all corners, but really how the markets weathered that. Duane, if we can, we'll start with you.
Yeah, thanks, Jessica, and thanks for having me. I would say that if we look and sort of think about where we were in January and February, and that just seems like a long time ago in 2020, we were already facing headwinds. We were starting to see some little bit of reshaping just based on demand picture that was focused on what we might call the energy transition. But it was much more forward-looking, and it was much more, sort of forecasting. And then we hit the pandemic, and we saw a demand drop that, was extremely profound. And that really was the big surprise, that we couldn't revive it. We couldn't revive it with OPEC moves and supply side types of things. And, over time, we've just been watching how fast demand is coming back. And we think about, end markets like jet fuel and other areas, and it's going to be quite a while before those return to normal levels, if ever.
Jim, would you like to take the next response?
Yeah, the most surprising things are the things we can't predict, right? I've spent the last 30-some years trying to project and predict, and Duane makes a good point on that. But the idea of negative $37 oil and the rig count dropping 80% in a quarter are two events that nobody would have ever predicted, even if you would have asked them to come up and guess black swan events. And I guess I'm surprised and impressed mostly by those events and how the industry dealt with it. I think the industry came to realize that $70 oil might be a little ways off, and instead of waiting for it to come back, we need to reduce costs again and more thoroughly now. We've been going through 4 or 5 years of cost reductions since the drop, since the peak in 2014, and about 3 or 4 times the companies have thought they were done, and they found out this year that, well, in 2020 anyway, that they weren't quite done, but they did a yeoman's job of cutting costs in one of the fastest dropping markets we've ever had to stabilize their business. And as we go into 2021, the bleeding has stopped. Surviving 2020 was the most impressive thing I've seen.
Very good points there. Surviving it, just getting through it. Subash, what surprised you really about what all took place and how they got through it?
Yeah, the first thing was for me that we were talking about natural gas again, bullishly. I mean, it was a decade of thinking that we would reach infinite levels of gas and gas would never trade. We saw it go from very high levels to thinking it wouldn't drop below 4, then 4 became 3, became 2. And all of a sudden, we had structural reasons to be excited about gas, at least for a while. Second, it was a recovery in the high yield debt market, because I think, as Duane was talking about, whether we ever recover back to prior levels, that was the discussion. While that discussion was underway, we saw companies be able to place debt in the midst of the crisis at very cheap rates, years out. In what is perhaps a dying commodity, or so the conversation went. I was very surprised by that. And then in the M&A, right, big M&A year, there was a couple I was surprised by. Concho was one. I thought they'd be a consolidator. For a strong company like that, to think that, a merger was their future was surprising. And then to see a WPX get acquired, but the only one of the deals where the acquired company becomes the new management team was was a big surprise for me. And the final surprise for me was that there weren't much in the way of gas mergers. You know, I felt like the time was right, and we haven't really seen much in that part of the hydrocarbon.
You know, that's interesting. Subash, you really do bring up some interesting points, and, you know, mentioning Concho and seeing that as a surprise as well. So that really transitions well into my next question. Jim, I'll start with you. On those points that Subash was making from an investment point of view, what has changed from the survival days, you know, of the summer of 2020, I guess, to really planning for some sort of comeback or really remaining as well?
Well, you know, we've run this industry for 150 years on growth and cash flow generation. And it's the only thing we ever knew. And the transition really started in 2017, and it took us a while to notice it. But I think what happened after the summer is the realization came that just generating cash wasn't enough. I mean, there's a point that several CEOs, several people in the industry don't even realize is a truism. And that is, if you don't earn your cost of capital, equity value declines. And so the industry is now wrestling with the idea that we actually have to be profitable, a positive bottom line, not just grow EBITDA. We actually have to be profitable, not just generate cash. And I think that's the biggest shift you've seen in the industry, the recognition that the valuation of this group, and keep in mind the valuation of E&P and service has never dropped. You know, you're at the lowest level in 22 years in terms of market caps and value creation in this sector. And the realization finally hit, I think, this summer, that survival is good and a start, but you actually have to be profitable in this industry, and you can't hope for, if you look at the future strip, you know, the next 10 years, we average $45. And while the future strip may not be eventually right, it's what's used for planning purposes by the industry. And so today, if you can't be profitable and earn your cost of capital in a $45 oil price environment, then you aren't going to survive. And that realization has come into the market since early this summer. And I think it's probably one of the most profound things in our industry in a very long time.
Profound words there. Duane, what is your take on that?
Well, I'm going to pick up on some of Jim's comments. I completely agree with him. And so what are companies really thinking about doing, you know, to actually maintain in this new environment? So the whole world of digital has given new tools and new capabilities to operate at reduced cost, which is really important to that earning the cost of the capital back. It's also, you know, we've seen it in large scale changes in employment, and we're seeing, you know, a lot more costs get variabilized. We're seeing, you know, different utilization of different types of labor strategies to move things along. And then sort of last and not least, it's been a time where those who were really agile and those who sort of took care of the balance sheet all along were in better positions. And you know, every single time we go through a shock like this and have to hit the reset button, we learn over and over again that, you know, we can compete at higher and higher levels, and that's really what we're going to learn here.
Right.
Subash?
Yeah, I mean, I would echo that we're definitely competing at a high level. It's a very clever industry. And, you know, maybe it helped to have the OPEC shock a few years back to be able to deal with this, right? You know, short of that happening, I'm not sure if the flexibility would have been there, but nonetheless, you know, they have become more nimble over the years. That being said, I feel like, at least as far as equities go, the easy money has been made. We're now pricing in a post-COVID recovery of some kind. Natural gas and crude have returned to levels that are somewhat normalized. And to drive the commodity beyond this point, we need some good things to happen. More importantly, we need bad things to not happen, right? And so I'm back into the world of counting molecules every week and barrels every week to try to figure out what prices are going to do. You can't make a thematic investment in the sector anymore, right? Given what the stocks have done. So we're going to wrestle with that as we get into 2021. Now, 2022, we might not be pricing that in, and that's what I feel like the game is about. If we can get, if demand is going to be in the mid 90s, I feel like we price that in on million barrels per day. If we're going to edge, closer to 100, we haven't, and that's going to be what we'll watch all the way through 2021. We're seeing that with natural gas right now. We've sold off on natural gas, and gas is down, right? Because while the theme of a recovering gas sector on low supplies and low associated gas really helped us, now we're dealing with weekly degree days. Are we on track or are we not? And that is what I'm mainly wrestling with. What has changed for me as I exit 20 and head into 21?
And if I can continue with you, what growth sectors do you see for companies really, Subash, in 2021? Are there areas that maybe they hadn't thought about that they could somehow profit from, and really move forward?
It's been my number one topic because some things are not going to return to normal, right? One of those things is rewarding growth. I don't feel like we're going to be, unless we get another demand shock of some kind, which I don't think anyone's predicting, right? The conversation is about peak demand, not, the next China. We may not reward growth again in the sector as far as traditional energy goes. And when you look at clean energy, you're finding companies with with no revenue, no profitability predicted for many, many years, all of a sudden being worth so much overnight. I would love to see somehow the upstream companies bridge the gap into new energy, right? I don't know if there's a natural fit. It's beyond me. But if there was, that would be a wonderful transition. Because what I really worry about is this idea that we just cash flow to death. We dividend to death. That is just not appealing from an equity perspective. You can get to a 4% yield, 6% yield, doesn't matter. You got Exxon at 10 or whatever it is. It's just not appealing. It is a slow death. We have to figure something else out here. And we see the new energy model being rewarded. And I feel like it's in the very early stages of that. This is just the beginning, just like early shale. I want to see this industry somehow bridge that divide.
What are your thoughts there, Jim?
Well, it's interesting. I moderated a panel a year ago on ESG and the rest with major oil companies in Europe, Eni, Repsol, and BP. And they all acknowledged that the returns on their sustainable, renewable efforts would be lower than that of their core business, but that they would get multiple expansion from having more of their business being sustainable. And to Subash's comment on what they grow into in the future, BP is obviously taking the lead, though there's some questions. Other oil companies are following suit. And it's going to be interesting to see whether investors will accept a lower return happily, and whether that will actually expand the multiples. But overall, there's no question that the world has changed and growth is no longer the driver, and ESG is more important than anyone would have expected 2 years ago. And I think it's very incumbent upon our industry to kind of move out of the Stone Age in terms of global ideas on such things. I know people still think, some people think ESG is a flash in the pan and will go away. I know some people think that as soon as oil goes to 70, we'll get back into growth mode, and all those people who were looking at value and returns will go away and jump on growth. And those things just aren't right. Once a sector is moved from growth to value, they never get moved back. The portfolio managers at Fidelity and Wellington who own that stocks aren't going to change their fund's strategy because oil hits 70. And so I think that the oil industry is very rapidly understanding what the new reality looks like. Subash's point, we don't know what it's going to look like, but we know generally where they're headed. And so I think that's a very positive development. We'll see what the reality looks like.
And Duane, following Jim and Subash, do you think that, of course, the importance of ESG for many companies, is that a growth area, or is that just going to be a focus on figuring out how it can be one day, or do you see other areas that then they can try to benefit from as well?
Well, I think it's all going to be related to ESG. In the center of it all, I think the big new dynamic that is there in addition to regulation and regulatory pressure is that the consumer is starting to really make up their mind on what they will consume, what they will use and buy, based on the track record of ESG and in the supply chain. So with that going on, there really isn't any choice if you want to sort of figure it all out, but to reset the core business, to calibrate it to the demand that's going to be there for you, and then to look at edge investments that can really drive growth. And that doesn't necessarily make you a growth company, but it gives you the opportunity to sort of play in both worlds. And that's really going to be important.
Remaining relevant there. Subash, we talked about the Emp sector, we know really took a hit in 2020, as many did, but some were saying in conversations I had that maybe international interests would be where companies were moving to try to survive the rest of 2020. So what do you think about 2021? Is that true as far as international markets, or can we look to see investment and time and money in the North American market as well?
Yeah, I did a lot of international names pre-shale. And my one takeaway was that when it came to international equities, companies involved in international exploration and development, it was very hard to make it a company versus just a project. There was just too much of the risk that we take for granted in the US, that we have functioning laws, that tremendous stability here, and the tax regime is very predictable. These things that we take for granted here, you just cannot internationally. It was very hard for me to find a company that transitioned from a single project to actually being an international company. And what I mean by that, I mean not in the mega cap space. We know the mega caps can do that over a period of time, but I mean in a larger investable space. So while I believe that hydraulic fracturing has worked here, it is yet to be applied in a great way internationally. There has to be opportunities to do that. I think I am still challenged by the risks that I have experienced in my career in these equities. I follow a company right now, for instance, that has made a phenomenal discovery in the shallow waters of Mexico. And we're just rumors and press releases away of a big neighboring country of ours not having the laws in place to allow that to be developed in an equitable way. If we can't have it happen next door, I just don't know how we do it, anywhere else.
Very good points. Duane, can I ask you your thoughts on that as far as, what the Emp sector, what you're seeing them do as well?
Yeah, I would just say, so in response to the disruption that we've been through, the oil field services have been hit hard. The capital budgets of all companies, and has kind of moved sort of towards a decapitalization of shale. And I think there's a whole cycle of change that they're going to go through in the shale area here in the US that's going to make it even more competitive and harder to copy globally. So I kind of, with Subash on the ability to internationalize this, it's going to take some time, and it's going to be harder and harder to do the longer it takes too.
A lot of moving parts. Jim, what can you add to that? What are your thoughts there?
Well, everybody in the oilfield service business has decided that the U.S. is going to be long-term a very low growth market, and that international, which is expected to bottom in terms of activity either fourth quarter or this quarter, first quarter, believe that it'll start improving from here. That may very well be the case, but it looks to be a low angle slope. Aramco put out a letter in the last couple of weeks asking everybody for cost reductions, price reductions in their business. And so it's not, it's a better place to work than many places, and still not a perfect place to work in the Middle East. But there's no question that internationally, you're talking about 80 different countries we operate in. There's probably 10 or 12 that are really critically important to the oilfield services business. What's interesting is the companies are deciding, though, in the push to focus more on returns. They don't have to be everywhere and do everything for everyone. And that will lead to a great deal of opportunities for different companies owning different assets, services, businesses that can do better with them. But overall, right now, international is the focus of the oilfield service business as a growth market, whereas the U.S., at least for the next couple of years, doesn't appear to be.
And gentlemen, I really appreciate all of the knowledge you have. So I really would like to ask you, as sort of a wrap up, I guess, with your resources and what you've seen, do you have a few sentences for the industry, whether it be the things that we touched on here, ESG, very important discussion going forward because companies are figuring out what that looks like for them managing it. There's a lot of uncertainty in the politics realm, of course, how that will affect the energy industry. So if I can, Duane, if you would give me your final thoughts on that and anything else that you'd like to mention, do you think that is important part of this conversation as well?
So it's an exciting and disruptive time, and in a way, we're all pivoting to a new energy future. It's just what has to happen. There's going to be a new energy workforce that we have to think about. There is going to be a different method of allocating capital into this space. And we're going to have to live with volatility, which means we're going to have to be way more agile. This isn't the end of ups and downs. It's always been here, but it's probably going to get a little bit more frequent and a little bit more severe. And then probably we all need to get ready for more consolidation in the industry. So a lot ahead, and it's an exciting future if you choose to look as an essential resource, which it is, and that's why it's been so good for so long is its ability to adapt and to think through these very difficult problems.
Thank you for those words, Duane. Subash, can I turn to you now?
Yeah, I think along those lines, I'd say that forget about the past. It's past. It's not coming back. And when we look at the future, to be relentlessly opportunistic and flexible. What concerns me are sometimes when a company says, well, here's our approach, right? This is our approach. It doesn't fit our approach. I think we just need to be a lot more flexible than that, because I think, as Duane's suggesting, that the future is going to look nothing like the past.
Jim, if I can get you to round this out.
Well, I agree with both gentlemen, and especially Duane, your comments on how the industry is going to get through this. There's no question everybody understands consolidation is required. It's just that everybody else wants somebody else to do it, not them. The number of companies that are out there and able to lead the consolidation is exceptionally limited. And the valuations are challenging. You've got to break even EBITDA, so you have an infinite multiple, which makes it difficult. You put $1 billion in capital into your business in the last 3 years, which is now valued at about $100 million, and you're never going to get that money back. And so all those and the social resistances to consolidations have existed for a while. But it's kind of perverse, the fact that all the CEOs have had all of their option values wiped out in the last 2 years means that, to go through restructuring, come out clean and start consolidating the industry, they actually don't give up anything. They actually gain something. So we're actually to the point in the industry right now where consolidation not only is an option, but it's a requirement, and it's one that provides benefits for everybody involved. And that's a rare point to get to. Again, I think the industry has to focus on being realistic in the current market, and the idea of, well, we'll kick the can down the road, or we'll set ourselves up to play when things get better. those ideas aren't going to float, and it's going to especially not float with the boards of directors of these companies. Investors are not exactly thrilled with a lot of the directors of these companies that have sat by idly and done little while we've had 100+ bankruptcies in the sector. And so you're going to see the boards of directors of these companies take a much more active and fiduciary role in the future. And so when the companies, this month and next month start having their fourth quarter board meetings where they have to tell their board what their outlook is for 2021 and the next 3 years, they're going to be giving that to a board of directors that's in a very different receptive mode than they might have been the last couple of years. And I think that's going to help 2021, 22, help clean up the industry and allow us to be in a much better shape going forward.
Well, gentlemen, I have to really thank you for taking the time to spend with me today and to share all that information with us. On behalf of myself and Hart Energy, I really appreciate all of the knowledge that you share with us and really look forward to talking to you all in 2021 as we continue this year as well.
Thank you, Jessica.
Thank you.
Thanks, Jessica.
Thank you.
For more Hart Energy videos, follow our social media channels.